Okay, welcome back to the General Contractors Business and Finance Exam Preparation, right? So today we're going to be on chapter 3, which is financial management. And just the way we've been keeping it consistent, anytime we hear anything that pertains to accounting, all you want to know is you're going straight to chapter 3, right? This is the accounting chapter. And so here in chapter 3, it's a little bit different than all the other chapters. Reason being is because chapter 3 is broken up into two parts. So here is the simple accounting structure. This is just general accounting principles, general accounting terms, and this goes on from 3-9 all the way down here to 3-66. And that's part 1. And as you can see, this is a blank page. Basically separate accounting, general accounting, with general contracting, which is construction accounting. These are different things that you will also have to know. And this is part 2. And this goes way into depth, and you're going to get a lot of questions within this chapter. But the bulk of all the questions you're going to get on your test are going to be within this chapter. But the cool thing is you don't need to know all these definitions. You just want to mainly know where to find the information and how to find the information. All right, so let's get started. Right over here, we're on 3-9. That's the introduction, which we don't even need to waste time and read, all right? We're gonna go straight to 3-10, which starts you off with the general definition of bookkeeping versus accounting, all right? So 3-10, like we talked about, right at the bottom. And what is bookkeeping? Bookkeeping is the recording of business and financial data in a prescribed manner. That's all you need to know, right? And then accounting is the preparation of reports based on the recorded data and the interpretation of the reports. All you need to know right there. And I highlighted it this way because a lot of this stuff is not important. I just need to know the definition in the most concise way. So when they ask me the question on the test, I know exactly where to go to find it, right? And then here, we're basically talking about a business that's getting established. Starting a business. The most important thing you want to know here is a proprietorship is a business which keeps accounting records separate from those of its owner, but is not legally separated from its owner. You want to know this because they'll ask you a lot of questions on the test pertaining to proprietorship. And then here, these are journal entries of what it looks like when a business owner deposits cash into a business. So you can see right here, cash in the bank, 50,000, claim against things owned, 50,000, right? So we don't need to waste time and get boggled down on this. But the next important thing you want to also know is the balance sheet. Here you're being introduced to the balance sheet, which is basically a summary of things owned and claims against things owned on a balance sheet. And then down here, you want to see liability. You just want to know liabilities claimed against things owned, right? That's about it, 3-11. Keep in mind, you're being introduced to these contents in these few pages. And then you want to know the general accounting formula. That's the only accounting formula that there is. Assets equal liability plus equity. All you need to know, I promise you, right? And then here, we have changes in equity. So what that means is there are two ways for equity to change. There are investments or withdrawals by the owners and earnings for losses by the company. All you need to know, all right? Flip over to 3-14, changes caused by earnings, right? So the only thing you want to know is this increase in equity was earned by the company, not invested by the owner. So we show a separate category in the equity called earnings. So when a business, they start to take on jobs and they obviously have to hire and pay people to do those jobs. And that's where account payable comes in, right? Then they completed the job, then they're paid. The money that they receive is called earnings, or you can call it, in this case, earned income, right? And so if a company loses money in the future, the losses would reduce the amount of earnings by the amount of the loss. All you want to know is the balance sheet has to equal at all times on both sides, right? So on 3-15, we have revenues and expense. And you want to know, you want to highlight the word revenues, you want to highlight sales, you want to highlight expense, because you want to know these actual definitions. Revenues are the money a company is paid or expects to be paid for goods or services it provides to its customers, right? And then the word sales is sometimes used in place for the company that sells products instead of service. These terms are used not synonymously, but they're kind of mean the same thing. So revenue just basically means you performed a service, you got paid, money's coming in. Sales, same thing. You have a product you sold, you got paid, money came, money's coming in. And then expenses right here, as you can see, are the amounts a company spends to provide goods or services to its customers, right? Let's go straight to 3-16. And then it says when to record revenues and expense, right? Revenues recorded on the financial records at the time the title or ownership of the good or services passes to the customer, right? And then for those that are in the sales business, it states that a company provides services. This usually means the service or the contract for the service are completed. And then you want to know account receivable. Account receivable right over here that says the amount receivable from a customer for goods and services is an asset called account receivable. Okay. And then here you want to know how to record transactions on 3-17. And we can skip all of this. Okay. The most important part at the bottom is right here, the accrual method. So it states that this method of accounting for revenues and expense when they are earned or incurred. We're going to learn what that word means because you'll get a lot of questions on the test about incurred expenses or income, rather than when the cash is actually received or paid. This is called the accrual method. All right. 3-18, just to kind of go back to see where we're at. You can see that we've already moved down this whole thing down here. We're on 3-18. Okay. And then here, there's really nothing important. I just highlighted these for me, just so I can know what they mean to me. 3-20, debits and credits, right? So you want to start highlighting your stuff here when you get to debits and credit right over here. Your debit and credit. You need to know what a debit is. You need to know what a credit is. So on 3-20, it states that debit and credit. Debit right here, this paragraph states, debit refers to the left side of an account and credit refers to the right side of an account. All right. And then it states that accounts which have balances on the left side of a balance sheet have debit balances, and accounts which have balances on the right side are said to have credit balances. That's all you need to know. Kid you not. Right. And then on 3-21, we got this page right here, general basic definitions. Right. So debiting, instead of saying debiting the account, you just say debit the account. And then instead of saying crediting the account, you say credit the account, right? And then most importantly right here, you need to remember this because they'll try to ask you some questions. But the most important part is you just have to remember that the left side of the account where assets are, assets have a debit balance. And then liabilities, they have technically a credit balance, really. So when you have an asset, if you want to increase that asset, you're going to debit it. And then to reduce an asset, you credit it. All right, so we're on 3-22 now, revenues and expense. The debit and credit system also works for revenues and expense. You want to know that, right? Increases in revenue increases the company's earning and therefore increases the equity in the company. Additional revenues should therefore be recorded as credit to revenue accounts, and revenue accounts would normally have credit balance. So remember, we talked about debit, assets, liabilities, earnings. So assets are always going to be on the left side of the balance sheet. And then all the other stuff will always be on the right side. Expenses, liabilities, earnings, they will always be on the right side. Therefore, they'll always have a credit balance unless you debit it to reduce it. Okay, maybe a little confusing, but we'll get to that point where we can break those things down. All right, the income statement. This is one of the questions that I've seen on this test numerous times. They want to know if you know what the definition of an income statement is. All you have to really know about this is that a statement which shows earnings over any particular period of time is called an income statement. That's it. Sometimes they may say that the income is also called net income, profit, or net profit. That's literally all the same thing. Okay. 3-23 now. Debits and credits after both statements. Okay, so after the business year is over, the earnings section of the balance sheet will have two accounts, previous year earning, and current year's earning. The current year earning will be the same as the net income on the income statement for the business year to date. All you're basically saying is that income that you're seeing was from last year, and then the income that you're seeing coming in is for this year, right? That's all that they're saying. Kid you not. The next important thing that you want to know is, well, remember to always revert back to the table of contents so you can know where we're reading. So I underlined the word journal, which in case you don't have to do it, I just did it so it can stand out to me. So when they ask me a question pertaining to accounting, first thing I'm looking at is journal. In journal, I'm going straight across 3-25. I flipped the 325. What is journal? It states that the journal, you'll learn how to use the journal to keep track of all your business transactions. That's all it is. It's just a book where you keep track of all of your transactions. And then further down, we have it right over here. It says that this being the case, he sets up his book in which way to list by date all the transactions he has recorded in his financial statements. Such book is called a journal or general journal. So this is an example of a journal entry. He took out $50,000 that he had in cash. He deposited into the business, which is on the right side, which is credit. So that's all that is. That's a journal entry. It's showing you where the money is being moved within the company. And it states that the journal is a company's primary record of all businesses' transactions. Transactions are recorded in the journal before they're recorded in the financial statement. We have this section right here, charts of accounts. And you want to know this because I've gotten numerous questions about this. And a chart of account is a list of all the accounts by their account number. It functions like an index for a book, right? And you have an example down here. You might want to go through and read that on your own time, right? And then most importantly, right over here, we have a chart of account. As you can see, all these accounts are categorized. Cash in the bank has its own specific code. Account receivable has its own specific code. Truck, own specific code. Bank loan, they all have their own separate code. And all that is just a chart of accounts. All you're remembering is you have different accounts, and this is the main page where you see all of those accounts. It's like a snapshot. And then here is a journal entry, and it shows you that this is where the cash was invested. You see that they bought a truck, they paid cash. You need to look at this so you can know what all of these mean. And continuation of that same right on here, 327. And then we move on to the ledger. We're on 3-28. We're making progress in these streets, right? 3-28, the ledger. This section tells you how to use your ledger and to keep track of detailed account information. And then what I did was I highlighted the word ledger because I need to know what it means. It's a detailed record of one account. An example, account payable, right? Remember how we said that we have a chart of accounts? So account payable, this right here is considered to be a ledger, right? It's an account, but it's a page that basically gives you a detail of all the track records of that particular account. So here's an example of this right here. You can see in the account payable, here's what took place in the account payable. And then this is a definition you want to know because they'll ask you this on the test. I saw this question. It says the process of transferring information from the journal to the applicable ledger is called posting. Highlight this. You're going to see this question. I can promise you that, right? And then right over here on 3-29, it starts to go a little bit more in depth. Now we're talking about trial balance, and then we go straight into the balance sheet. The balance sheet, which I highlighted right over here, 3-29, the balance sheet. I put a little star next to it because they will ask you a lot of questions pertaining to the balance sheet to see if you know what's the difference between an asset, what's the difference between equity, and all that, right? So the balance sheet on 3-29, it states that the balance sheet categories, whoa, English 101, I need that. The balance sheet categories include current and fixed assets, current and long-term liabilities, and equity. So you want to know what an asset is. We talked about that earlier. And most importantly, these are questions I got on my test a lot. Current assets, right? Current assets are assets which are converted into cash in the ordinary course of business within 1 year or less. Keep that in mind. 1 year or less is current asset. They're listed in order in which assets most easily to be converted into cash. So current asset, all they're saying is going to always be on top because they can be converted within 1 year, right? And then fixed asset. Fixed assets are assets such as land, building, equipment, trucks that are used in the operating the business and which have long life. They tried to trick me with this. They tried to ask me if land was a current asset. And it's not, because we just see literally right here on page 3-29, if they ask you a question about asset, instead of you wasting time, you're going straight to chapter 3 because we know that's an accounting concept. So you're going to go straight to chapter 3. You can use the index if you want, but most importantly, we already discussed that we're going to be looking in chapter 3 for anything that pertains to accounting. So if the question comes up, what is a form of a long-term asset? The first thing that should come to your mind is you're going to chapter 3, which talks about accounting, and then you're looking at your table of contents, and you know that balance sheet is where you'll see assets, which is right here. You flip to 3-29, and then you see current asset. You have it 1 year or less. And then you have fixed asset, and you have all these examples of fixed assets. And that's all you're doing, bro, literally for the whole entire test. You just know where the information is and you flip to the right page to find it. And that's what I'm teaching you guys to do. Next, you have liabilities. Remember, we talked about liabilities. It's debt and money owed to others by the company. Voila. And then just like there's current assets, there are current liabilities, right? Current liabilities are liabilities that are due to be paid within 1 year or less, right over here, right? And then long-term liabilities, same concept as long-term or fixed assets. It states that they are not due to be paid within the next year. And then they give you some examples. Okay, we flip back. We're making progress, guys. We're down to 3-30, right? And then equity, the amount of money that was invested and the amount of earnings of a company is called equity, right? And then here's where they try to trick you. We're on the income statement and we're still under the balance sheet, but the income statement is an element within the balance sheet. And what the income statement is, a category of income includes revenue, expenses, income. All you want to know about an income statement is it gives you like a snapshot of a particular period, a particular accounting period of a business. So for example, January 31st, let's say we keep our records every month. We want to look at our business progress every month. The first thing you'll do is look at your income statement for that particular month. On the balance sheet is where you see clearly you have your assets. And keep in mind, current assets are always within 1 year, so they're on top. Then you have your fixed assets, and then you have your total assets. On the other side, you have your liabilities. You have your current liabilities. You have your long-term liabilities. You have your equity, and these numbers always equate to the same thing, right? And so now let's go down here to expenses. Expenses to provide goods or service to the customers to carry on its business. Basically, the cost of doing business. It states that operating expenses are expenses that are incurred while providing the goods or services that the company sells. Cost of doing business. 3-31, administrative expense. It states that these are expenses incurred in the administration of the business and do not particularly relate to providing particular goods or service. Income. This is where things get a little bit tricky. Not really. This is called net income, profit, net profit, and is the income of the period referred to on top of the income statement, right? And so what they do, I just want to make sure this is clear for you guys. I want to see how simple this is, but it looks so complicated. So when we go back to the other pages, you'll see that they took on some jobs, right? Let me see if I can find it for you. So you can see here, this is an income statement, 3-24. So the income statement is from February 1st to March 15th. That's their accounting period. Revenue, these are the two jobs that they took on, right? And they totaled to $24,000, okay? Expenses, these are basically the cost of doing business. Wages, they have to pay people that work for them. Subcontractors, they have to pay subcontractors. Maintenance, they have to pay all these. And then you get a balance of $13,020. And all you're doing is you're taking the $24,000 from the revenues that you were generated, and you deduct the $13,200, which is the cost of doing business, and then you have a net income of $10,800. It's the most basic math, but they make it seem like it's complicated, right? You take your revenues, you minus your expense, you get your net income, and that's what your income statement tells you. So when you go in from the month of February 1st to March 15th, You're literally just looking at, okay, I took on these 2 jobs. Here are the expenses for taking on this job. Here's the money that I walked away with for this job. And that's found on the income statement, right? And here's another example of the income statement. You see that they took on these 2 jobs. Here's the total revenue. That's the amount of money that they brought in. And then you have the expenses, and it tells you the total operating expense. That's the cost to do it total. And then you deduct all of your overhead. You deduct all of that and you get your total expense, and you deduct that from your revenue, and boom, here's your income for that particular period, right? 3-31. Congratulations, we're making progress. Adjusting entries, very important. Adjusting entries, when and why. The financial statements shown on the previous page are correct and that they account for every transaction, but they need to be adjusted for changes related to accruals. Now, what is accruals? We're gonna learn about that very soon. And just remember, we wanna flip back just so we can remember where we're at. So we're right here, 3-31. And then we have 3-32 now, right? The accrual method of accounting, you wanna know this because I saw this question on my test. The accounting method of accounting says that we should try to match revenues and expense at the time we record revenues. All that's saying is you try to basically see the period in which you had the expense and you tie it to that time that you had the revenues, okay? So accounting period is the period of time over which income is calculated. Simple as that. Down here, we have adjusting entries, usually done after the trial balance is prepared and proven to be correct. After the adjusting entry are posted in the ledger, an adjusted trial balance is prepared to ensure that no posting or adding mistakes have been made. So it's basically you going checking your work, right? So here we have prepaid expense, and we're still on 3-32. Prepaid expense right over here. What is a prepaid expense? Prepaid expense are assets that have been paid for, but which in case will become expenses over time. Insurance is a good example. An insurance policy is an asset, if it is paid for in advance, will last for a year of time and expires on a fixed date. So for example, you have your insurance right here, it's 2000. An example where prepaid can be shown is use of supply, right? Maintenance supply are used throughout the year. Let's go to 3-33, just so we can keep track where we're at. 3-33. So we have bad debt. And so bad debt are basically when you lend money out on credit and then these people don't pay you